What if I told you that a three-digit number can decide whether you get your dream home, your next car, or even the apartment you applied for last week? Not your salary, not your education, just three digits. Most people don't learn how this number works until it has already cost them thousands of dollars. And by then, it's too late. But here's the strange part. The credit score system doesn't measure how rich you are. It measures something else entirely. Today, we're going to break down how the credit score system actually works, the formula behind it, the biggest myths people believe, and the habits that quietly raise or destroy your score. Stay with me, because later in this video, I'm going to show you one small credit card habit that can drop your score by 80 points overnight. Let's get into it. Welcome back to Money Science AR, the channel where we break down the science behind your money in simple language. No complicated jargon, no confusing financial terms, just clear explanations about how money systems actually work. If you're new here, take a second and hit subscribe, and turn on the bell so you never miss a new video. Because once you understand how financial systems work, you start making much smarter decisions. Today's topic is something almost everyone has heard about, but very few people truly understand: credit scores. We're going to look at what a credit score really measures, the 5 factors that control it, the myths that cost people money, and the fastest ways to improve your score. Let's start with a story. Let me introduce you to David. David is 27 years old. He works a steady job, earns a decent salary, and has never missed paying his rent. He pays his phone bill on time. He pays his utilities on time. He even repays friends quickly when he borrows money. By normal standards, David is responsible with money. But when David walks into a bank to apply for a car loan, something surprising happens. The loan officer pulls up his credit score. It's 580, just barely above the poor range. The bank still offers him a loan, but the interest rate is 14% instead of 5%. On a $20,000 car loan, that difference could cost David thousands of dollars in extra interest. David is confused. He says, "But I pay everything on time," and he's telling the truth. But the credit system doesn't see those payments. Why? Because David never used a credit card. He paid everything with cash or debit, and his rent payments were never reported to the credit bureaus. So to the credit scoring system, David has almost no financial history. This is something millions of people experience. They are financially responsible, but the credit system has no record of that responsibility. To understand why, we have to understand what credit scores actually measure. A credit score is not a measure of wealth. It's a risk prediction tool. In simple terms, it answers one question: how likely is this person to repay borrowed money on time? That's all. The most widely used scoring system in the United States is called the FICO score. It ranges from 300 to 850. Here's how lenders generally interpret the numbers. The higher your score, the more lenders trust you. And the more they trust you, the lower interest rates you usually receive. But here's something many people don't realize. You don't actually have just one credit score. You have several. Different lenders may use different versions of the FICO model. There's also another scoring system called VantageScore. But almost all of them are built using the same 5 ingredients. Once you understand these 5 ingredients, the entire system becomes much easier to control. The 5 factors. Think of your credit score like a recipe. 5 ingredients go in, 1 number comes out. Let's break them down. This is the single most important factor. It answers one simple question: do you pay your bills on time? Every on-time payment improves your score. Every missed payment damages it. Even one late payment can cause a noticeable drop. That's why many experts recommend setting automatic payments for at least the minimum amount due, because one forgotten bill can undo months of progress. This is the second most powerful factor. It measures how much of your available credit you are using. For example, if your credit limit is $10,000 and your balance is $3,000, your utilization ratio is 30%. Most experts suggest staying below 30%, but the best credit scores often stay under 10%. Here's the part many people don't realize. Your credit card company reports your balance at a specific time, usually when your statement closes. So even if you pay the full balance later, a high reported balance can temporarily lower your score. This is why some people make 2 payments per month. One before the statement closes, and another before the due date. Small timing changes can improve your score. Credit systems reward long relationships. Older accounts help your score. This is why closing an old credit card can sometimes hurt you. Even if you rarely use it, that account is helping your average credit age. The longer your credit history, the more predictable your behavior appears to lenders. Lenders prefer to see different types of credit: credit cards, auto loans, student loans, mortgages. This variety shows that you can manage different financial responsibilities. You don't need every type of credit, but having only one type may slightly limit your score. Every time you apply for new credit, a lender performs a hard inquiry. Hard inquiries can lower your score slightly. 1 or 2 per year is normal, but many inquiries in a short time can make lenders nervous because it may look like you suddenly need a lot of money. Now let's talk about myths. These misunderstandings cost people money every year. Myth 1: checking your credit hurts it. False. Checking your own score creates a soft inquiry, which does not affect your score. You should monitor your credit regularly. Myth 2: you must carry a balance. This is one of the most expensive myths. You do not need to carry a balance to build credit. Using your card and paying it off in full works perfectly. Carrying a balance simply means paying interest. Myth 3: high income equals high credit score. Income is not part of the credit score formula. Someone earning $300,000 could have a poor score. Someone earning much less could have excellent credit. Credit scores measure behavior, not income. Myth 4: closing cards improves your score. Often the opposite happens. Closing a card reduces available credit, which increases utilization, and it may shorten your credit history. How to improve your credit score? Now, the most practical part. Here are 5 steps that can improve your credit score. Step 1: pay everything on time. Payment history is 35% of your score. Even one late payment can cause damage. Auto pay is one of the simplest protections. Step 2: reduce utilization. Aim for below 30%, ideally below 10%. You can also request a credit limit increase. If approved without a hard inquiry, your utilization improves immediately. Step 3: avoid too many credit applications. Space them out. Too many inquiries signal risk to lenders. Step 4: start building credit early. If you have no credit history, consider a secured credit card. You deposit money as collateral. That deposit becomes your credit limit. Use it responsibly, and your credit history begins building. Step 5: check your credit report. In the US, you can get free reports from Equifax, Experian, TransUnion. Studies show that about 1 in 5 credit reports contains an error. Correcting mistakes can improve your score quickly. Why credit scores matter? Let's go back to David. After learning how the system works, he opened a secured credit card. He used it for everyday purchases like groceries and gas, and he paid the balance every month. Within 9 months, his score increased from 580 to 690. Later, he refinanced his car loan at a much lower interest rate, saving thousands of dollars. But the impact goes beyond loans. Credit scores can affect insurance premiums, apartment applications, security deposits, even some job screenings. A higher credit score often means a lower cost of living. Let's recap. Your credit score comes from 5 factors: payment history, credit utilization, length of credit history, credit mix, new credit inquiries. The biggest 2 are simple: pay on time, keep balances low. Most people lose points not because they are irresponsible, but because nobody explained how the system works. Now you know. If this video helped you understand the credit system better, hit like. It helps more people find this channel. And if you want to keep learning how money systems really work, subscribe to Money Science AR and turn on notifications. Drop your biggest credit score question in the comments. Your question might become our next video. Until next time, stay curious, stay informed, and keep building your financial future. See you in the next video.